VCs should feel immense existential dread with AI. For a lot of yesterday's VCs who've overraised, who are like your average mid-tier old school fund, they're not going to do well. Those LPs are not going to get their money back. From an AI standpoint, imagine if you're Nike and some of the best NBA players are like, I don't really need shoes anymore. Like, what are you going to do? That's exactly what's happening. Like, you are seeing great entrepreneurs, founders who are like, I don't want to raise $1. Whereas it used to be, I have to raise money.
Amit, welcome to the Slice Pod, where we uncover the stories of fresh emerging managers across the early stage venture landscape. You are the co-founder and managing partner of Earl Capital, an early stage fund investing alongside your former Clearbit co-founders in over 100 companies since 2020 across sales and marketing tech, fintech, developer tools, and the likes. And we'll get into the more nuanced details of your thesis in a second. But before, let's begin where we always do, which is by asking, how did we get to this point? Was it always the plan for you guys to consolidate into a fund and start managing other people's capital?
No, it wasn't always the plan. I took a very odd and indirect, time-consuming way to get there. Earl Grey came out of being in tech and startups. We were co-founders of a company called Clearbit, which we sold to HubSpot a couple of years ago. We started the company in 2015, and we were just working with a lot of startups, and I think built a very good brand with startups. We built products that people really loved. We worked with probably every great B2B company, the Stripes, the Airtables, the Notions, many of them from when they were just starting out. And so I think we even open sourced some very expensive and very highly regarded exec coaching. So we did a lot of free products as well. So we weren't pricing out smaller companies. We always built a lot of brand and goodwill with startups. That naturally led to potential angel investing opportunities, which frankly, I didn't take very much advantage of. I'm kicking myself. It's probably a big regret. I should have. But yeah, we did that. And just by being around tech and getting a lot of value in meeting other companies, learning about what they're doing, and truly loving the game and being around entrepreneurs and other businesses, there's just a very natural extension into venture where you do a lot of those things, except with a very specific financial goal. You have to love doing it, love helping others, and love paying forward lessons you've learned, much like folks did with us. From there, it made a lot of sense in my own journey based on Clearbit and other things to start a fund.
It took you almost 10 years for you guys to exit Clearbit. What made you say, let's continue together? What was the aha moment where you were like, okay, we sold the company, let's build a fund? Some people may think it's a seamless transition, but I don't think it's that obvious, especially after spending so much time building it and exiting the company.
I actually stepped down from Clearbit towards the very end of 2020. The company was still running for a few years. I basically fired myself, and Alex stepped down. He was our CEO, stepped down shortly thereafter. We were still involved at a board level. Matt eventually took over as CEO. He's the third member of Earl Grey, still an executive at HubSpot. Ultimately, he's the one who guided the acquisition. So we were kind of always a hybrid. It wasn't like we sold and then stopped everything and did the fund. We'd been doing some angel investing, particularly Alex, and then Naval and Jeff at Accomplice as part of a program called Spearhead. Made it very easy to say, hey, you guys have more time and tons of access, but you don't have capital. Why don't you scale up some of your investing? You're the perfect archetype for founder turned GP. At the time, especially in 2020, AngelList was really helping facilitate easier fund creation with rolling funds and their vehicles. And so we were kind of a good poster child. Alex and I asked each other, if we're going to do anything, let's play to win. We didn't want to be one of those like, oh, I have an angel vehicle and it's kind of on the side for soft statuses. Let's do this to make great investments and actually be in competitive deals. I was much more the natural fit as managing partner and CEO. So we kind of swapped roles where Alex is more for brand and for helping with technical evaluation. We did that first fund together, and I think we earned the right to the second fund, which is what we're deploying out of now. Clearbit sold in 2023, a few years after I had started investing professionally.
And you mentioned it's a very competitive space. There is quite a bit of exited founders turn GP enabled by the 2020-2021 SRP times and AngelList new platforms, not just AngelList, there's a bunch of others as well. Why do we need another emerging manager? Well, what need were you stepping up to serve?
Yeah, it's a great question. And the answer is probably different even a few years ago versus today. I think there's been an explosion. I'll address it on a few different levels. At a macro level, I think VCs actually are great and get a bad rap. I mean, there's a lot of reasons why, you eye roll at some VC being on CNBC talking about the IPO. It's like, dude, you didn't do shit compared to the founders or the actual team for the IPO. VCs deserve a lot of the eye rolling that happens every day. They really do. But overall, it's a beautiful thing. Imagine going to a bank and saying, hey, I want $1 million to start a company, and I'm probably going to burn it all, light it all on fire, and I don't owe you anything, but I'm going to take a swing at something that hopefully is improving the world, driving value for society, or creating new technology that people can use. I mean, that's beautiful, right? That's at the heart of what capitalism and technology is. Technology fundamentally is what's driven humanity forward over and over again, right? So being a part of that risk to give people money that mostly is going to go to zero for the small chance that something happens, and if it does, then everybody wins. Like, that's a beautiful thing. There should be more of that. And to the extent people can be VCs who actually have been founders and builders, that's even better, because chances are they're not going to fuck with founders. They're going to be more empathetic. And again, everybody says that on their website, but like, everybody knows once you're actually in the thick of it, who's a friend and who's not, and who actually can help people build their companies or get out of the way, frankly. And I think the more of that there is, the better. And then second, I think that just like any industry, the more competition there is, iron sharpens iron, the better the product becomes. Today's breed of people, like emerging managers who've had to fight through. I'm lucky in that we had quite a bit of brand from our company. Our first fund was fairly easy for us to raise it and do it. Second one was a bit harder to raise, but those folks are kind of starting out. Like, they've had to come to the table with great products. What are you doing differently in terms of deal flow, sourcing? You can't just say the same old bullshit like, we back generational founders. What does that even mean? You can't just come with the same platitudes that a lot of VCs have coasted on over the last 10, 15 years. You have to have a good product, because LPs are smart and haven't been that rewarded by venture, where they're like, okay, why am I going to want to dole this money out? So the product is just getting better. And that's great for the point I made earlier. It's great for founders. That's great for technology as a whole. And frankly, that's good for VC, because you can't expect to win deals if you're not good and you're not actually doing something better for founders and supporting them and actually delivering on stuff versus kind of just the same old platitudes. So as far as why there needs more capital, it's just good, right? It's good for everybody. For us, it was as simple as we're already getting great deal flow. So it wasn't like we need to figure out how to do this. We're already getting good deal flow. We just don't have the personal capital, because we didn't do a bunch of secondaries, this and that. We were very company and mission oriented, where it's like, we want this, we're going to do well with an exit, but we weren't finding other ways to do side hustles. We were all in on the company. And really for us, we were already getting great deals. By any objective standard, these were very competitive, good opportunities. We felt like with the right discipline around check sizing, we can get into a lot of these, and frankly more. Once we stepped down, then it actually compounded, because then we had way more time to help founders, way more ability to put our own spin on evaluation, especially for more technical deals, where on day one we were better than others. Also build our brand and reputation as founders who are very easy to work with. I mentioned earlier, we have quite a few investments. It's one of our bigger moats today. It's just the fact that we're not perfect, and certainly some founders we're closer to than others. But if you were to poll the entirety of our base, I'd say the vast majority would say that we're like a 10 out of 10 on the would work with again score. And I think that is something that only comes from sweat equity, where you actually do things you say you're going to do, and you actually spend time to help folks, not just the companies that are doing well, but even the ones who aren't. And again, I think there's good arguments to be made that you shouldn't just dump all your time into helping the portfolio, but it's genuinely things that we find fun. And that's helped us going forward with brand, reputation, deal sourcing, other things like that. To answer the question in a few ways, I think we just felt like it's right in front of us to execute extremely well. As we've gone from angel to fund one to fund two, we've sharpened our focus thesis a bit, where now I have a probably different answer than we did when we first started, saying, let's be professional investors. At the time, I think it was really just that it was right in front of us. And overall, we're very confident that we could do it well.
What's the pitch that you give to these founders? What are the vectors that you make yourself available as founders yourselves?
With the new fund, we certainly are a bit more specialized. I can't go to a DTC consumer founder for wine and say that I'm all that valuable. I'm just not. It has nothing to do with my expertise. I don't have 5 million followers on TikTok. I'm not actually valuable. Some of this is we've refined to where we actually know that, okay, maybe there's a lead, maybe we're the biggest check or second biggest check right after. is playing in spaces that we understand very well. Almost always founders know who we are and they're excited to have us on board already. So we're rarely in situations where like, hey, let me tell you about Earl Grey and Clearbit. It's like when we're in the world of developer platforms, API first companies and data companies, we're already pretty well known. When the knives come out, and believe me, in competitive rounds, the knives do come out, it's very easy to get into, your average round where nobody else wants to invest. In the competitive ones, it's very hard. Honestly, what I found to be most successful are a few things. One is being early and not being afraid to write the check. Hey, are they in? Then I'm in. You just got to rip it if you're really confident. Fortunately, we're not afraid to make those decisions. Like we were the first chicken to Crew AI. They've since done many rounds and are kind of an AI agent darling. I convinced the guy to start the company. He was a fantastic and incredibly talented engineer at Clearbit. He got an offer as part of the HubSpot acquisition. I was like, you shouldn't take this offer. You should start your own company. And this is the thing you should do. You're already seeing some success and you're really passionate about it. Here's the check. Do it. I got your back. Let's partner together. That's an example of where we went in early and then we can help convince Boldstar to come in and lead. The rest is history. Number one is just not being afraid to get in early. That works better when you have strong networks. We've had many deals where we've gotten to know people who are thinking about starting their company or just starting, and we're way ahead of others. We're not waiting for VC signal. So one is just not being afraid to go in. And at that point, you have more of a likelihood of getting the right allocation anyway. Second, throughout the process, it's like a freemium product. You want to give value before you ask for money. And I think we're pretty damn good at that, whether that's helping them think through, not just like, hey, here's other investors you should meet to. It's like literally do things to make sure you're successful, whether it's getting your founder share class specialized so you have more voting rights, whether it's thinking through the company or the product itself, whether it's helping them find their co-founder or founding team members. Like we've done all of that. And many times without asking for a thing back, just knowing that we'll be taken care of if and when the round happens. Helping connect them with lawyers. There's just a lot of early stage stuff that you only have through years of being in the space and having a great network, but actually doing it for people. Don't talk about it. Just do it. Just do it for people. And then they're like, damn, already you're standing out. And I think that's a way to also get in. And then lastly, I tell founders this every single time. If we're the only check or we're the biggest check, there's actually a problem. Like you're not actually arranging your cap table. And a cap table is basically a bunch of employees who generally speaking, you can't really fire, but they're also very purely incentivized by equity upside. So just like hiring a team, do you want everybody to look the same? Do you want one person to be like, hey, I'm going to do it all. Give me all the allocation. No, you would never build a company that way. You want some people who are really good for brand. You want some people who with big mouthpieces. You want some people who have time and effort to help you. If you get Elon Musk as an investor, he's great signal. He's probably not going to spend a minute helping you because he's too busy. Know what you're getting from each product and each investor. And we know where we slot and we know we're really good. And that comes from the things of like, you want to talk about board level stuff, but not at the board, talk to us. Like you want to talk about firing a co-founder. You want to talk about deep kind of experience, things that only other founders will know. Within our space, we're probably 1% experts to help you avoid a lot of problems. And then of course, we put in a lot of time and effort to help companies with tactical stuff, especially around go-to-market, hiring, what have you. But for the most part, that's just one chess piece. You should have other chess pieces on board as well. You're not even arranging your cap table well if you give it all to one firm who say they'll do it all. They'll do all of it, mediocre. Whereas you should actually think about diversification. That is a better cap table. I think just being very intellectually honest with founders is surprisingly effective in making sure that we do well and are rewarded by founders. This is going to sound arrogant, but it's like, look, anybody can get into a good deal or a hot round once or twice. We have over 100. It works. Like we're not, again, there's rarely deals we're in where nobody else is in or touching it. It's not to say that we're following people. Sometimes we do. Sometimes they follow us. We're just in constantly competitive situations, and that's by design.
Let's talk about that. Fund one was 9 mil, 100K checks, 60 companies, right? Yep. It's a pretty broad portfolio construction. And now you're 13 or somewhere around that number, and similar kind of like 100K check, very distributed type of model. How did you get there? Was it under that assumption that you mentioned a second ago that you need more than just one? And the earliest round, you want it to be syndicated as broadly as possible so we cannot own a lot of it. Did you borrow from what you've seen in your angel portfolio? How did it come together? It is very counter to the early stage fund model, lead the round, get 10% ownership, 20 portfolio companies.
I'll correct you a little bit. The current fund, we're certainly quite a bit more concentrated than we have been in the past. What you said that's very correct is we are mostly looking to write early stage checks that are in the, call it 300, 750K range. We're slanting more towards pre-seed. And to your point, that leads to a decent number of positions. We're not doing a ton of, A, B, C, pro ratas. And so far, if the trend lines continue, we'll have a lot of markups that we're going to say no to in follow-up rounds. I think we've thought through it well, and we're very lucky that our anchor LP Sandana completely agrees. They've done the math every different direction and also qualitatively have seen what works, what doesn't work. So we're very comfortable kind of bucking that norm. I'm happy to go into why. But with this fund, the goal is to basically have around the kind of 2 to 5% ownership mark early on. And, in exceptional opportunities, we'll take proratas and follow-ons and kind of bigger priced rounds. But for some, we won't. The nice thing is because we have a small fund, I think the math works very favorably for us where any of these kind of early checks become 50x, 100x, 200x type things, we're going to be in phenomenal shape. Some of that is a numbers game. If you get enough chips on the table and 9, 10-figure exits happen, we're sitting very pretty, even with some dilution, right? And that strategy works because we're a $13 million fund. It doesn't work if we were a $75 million fund. The math checks out, which I think is extremely important. We did not say, let's raise a $50 million fund and then figure out strategy later. It's like we understand exactly how to win with this size, this check, and our strengths in terms of where we fit into rounds. I think a lot of managers get in trouble where they think first about the size of the management fee check and the size they want to raise fund after fund, but it completely cannibalizes a strategy that may have worked for them as angels or otherwise. We're very lucky because of our own personal situations where we don't need to play that game. We are writing the top couple of positions in the rounds we're in. These are sizable checks in a few $1 million rounds. I think we frankly learned some lessons from doing that first fund where we really were higher volume, consistent check size, probably not as valuation disciplined as we should have been. And we're spread a little bit too thin where we very much course corrected in the second fund for a lot of those things where we are much more valuation sensitive. We are much more ownership sensitive and very thoughtful about having a smaller number of positions that we're writing bigger checks for, relatively speaking. All that said, the first one's tracking really well.
Do you think you found the perfect formula? Do you think that this becomes the franchise? Small funds, discipline on ownership. What's the future of Earl Grey?
Yeah, it's a good question. And I don't have a very linear answer to that. I think much like a startup, you have to understand the game on the field. And we used to say this at Clearbit. It's like every year a company has to reinvent itself, especially when you're hyper growth and the world's changing. The world's changing insanely rapidly now. So many things that were constants are now in flux. And so many aspects of what's worked in venture probably won't work going forward. I think way too much is changing way too fast to assume anything. I think you have to evaluate what are your strengths, where can you win deals, what's working for you. I expect that we'll have a great deal of data in a year from now in terms of what's working extremely well for Fund 2, as well as past positions that'll inform what we should be doing. I always find it funny that you see a lot of investors who are like, I invested in this company in 2002, and that's why you should give me money now. It's like, dude, in what world is that even remotely relevant for what you're doing now? Like maybe for LPs that plays, but I know founders like, oh man, you invested in like Uber in 2009. Therefore, like you get the number one spot on my cap table now, unless I'm literally building an app to sit on top of Uber. It's irrelevant. The game has changed so much in terms of what founders are prioritizing, in terms of even how people are thinking about capital. I think you're seeing a lot more founders now, especially second-time founders who've been burned by VC, who are like, okay, I'll do one round and then never raise again. What does that mean in terms of venture math? What does that mean in terms of those types of deals? How do you underwrite those? So much has changed with AI and LLMs that I think I'll take the same approach I took when we did the second fund, really ask ourselves where we can be successful and win. What does that look like? Now, I think we could copy paste this fund. Let's say we deployed the whole thing in the next 3 months and then do this successfully again. I think we could, but there could be arguments for doing something a little bit different. Like we're doing an incubation right now, which is a huge swing. It's an outsized ownership position for the fund compared to our average check. I'm spending a lot of time as a founder of the new company alongside a CEO and CTO. If that goes really well, maybe there's more of that type of model that could work where it gives enough upside and ownership in the fund where that can work. But of course, many VC incubations have gone bad. And so there'll be data to come from that. So to answer your question, I think the things I know are true are we don't want to just play the game and don't want to be like, oh, cool. Now we're doing a Series B fund to mark up all the deals of stuff we invested in. I want, $100 million. Hey, like, we're not playing that game. I don't want to play that game. Certainly, I believe that diversity of check does matter. It's fun, and that's part of why we're doing this. It does matter. If I look across where great returns have come from, it is a variety of types of deals. So I think it'd be naive not to make different types of investments. We don't necessarily want to be leading rounds where it's very zero sum. A lot of our success right now is based on collaboration. And the best way to cut that off is to start competing with the people you collaborate with. We don't need to play that game. We don't want to play that game. Those things will remain constant, but within the details of fund size, check size, ownership, focus, thesis, these are all variables that I'm constantly tweaking that'll inform if and when we do the next fund.
You touched on it, and I wanted to ask you about it. It's true. If you backed Sun Microsystem or Uber, you may not be that relevant. We are now undergoing massive, we're on the ascent of a massive S-curve when it comes to companies that can scale to a different tempo. It's not like hypergrowth used to mean going from 10 to 200 employees within a matter of months, just throw more buddies at the problem to work faster. Now you're probably just throwing a bunch of agents at the problem to go faster. So it's a very different tempo, very different way of thinking about things, very different way of fundraising as well. How are you guys navigating it? Because you come from the very last vintage, which was not built with these tools. It was not built in this season of venture.
Yeah, the plot is to advance technology and advance humanity and, use tools, which is what AI is and what LLMs are. They're tools to solve problems. And they're now maybe the greatest tool set humanity's ever had. The odds of solving things like cancer are dramatically higher now. It's almost like a function of compute. That would have been unfathomable 20 years ago, 50 years ago to even say out loud. And the fact that that's now within spitting distance is incredible. So I think overall, it's an incredible time. This is like my generation's internet. I was a kid when the internet came about in the 90s, 2000s, but this is like our generation. And look at how much the world is better off because of that. Overall, I'm very excited for technology and to be in a space where you're hopefully fostering that and pushing that forward through the prism of entrepreneurship, which is the single best way that actual things happen. Look at how slow government things move versus private sector capitalism. VCs should feel immense existential dread with AI. For a lot of yesterday's VCs who've overraised, who are like your average mid-tier old school fund, they're not going to do well. Those LPs are not going to get their money back. From an AI standpoint, imagine if you're Nike and some of the best NBA players are like, I don't really need shoes anymore. Like, what are you going to do? And, that's exactly what's happening. Like, you are seeing great entrepreneurs, founders who are like, I don't want to raise $1. Whereas it used to be, I have to raise money. Do you think any founder wants to sit around with their board all day? I'd say maybe some small percentage do, but most don't. It was kind of a necessary evil to get to the promised land. If you don't need that anymore, you're not going to do it. And so you don't need the same amount of capital. You don't need the same amount of people. Often what slows companies down and turns startups from efficiency into yet another kind of hit the dust. I believe people should bring other people along the journey. Like, companies shouldn't just be one person. There's a lot more to it than just a low number. So the point is you need less to do more. That's a good thing, but not necessarily a good thing for VCs because you are relying on people needing your money to do what? Hire, to spend on SaaS, to, again, mostly hire, right? Everybody knows what the balance sheets look like at companies. Most of it is software anyway. It's mostly people. A lot of these conventions are like, you get to this stage, you're unprofitable, you need money, and then you get the next stage. So many pillars of VC are built on that. There are companies, OpenAI's, Cursors, who are like, we are playing this multi-billion-dollar, trillion-dollar game. We're taking capital, we're using capital, we're growing insane, we're spending. They're playing the kind of classic venture game and playing it excellently and amazingly. But I think you'd be naive to think that that's how everybody's going to do it. Whereas a lot of venture dollars will be wasted on plays that are different when they never should have gone down that road. And so I think just a lot of the models that have worked in VC are going to break with people just needing less capital to build really big and interesting companies, big in the sense of revenue, big in the sense of the problem they're solving.
It's interesting what you're saying. It makes me think about the fact that we've seen a new breed of emerging managers like yourself coming through the ranks. And originally, I think it was a byproduct of established funds going bigger in size and creating a vacuum in the earliest stages. What is happening in conjunction with this massive AI-driven S-curve is that we're going to get to a place where you either deploy the capital at formation, or you're not going to be able to own a piece of that company until much later when you need to deploy hundreds of millions. So that middle point where most of the venture money has been concentrating over the last few years, those $50 to $500 million funds are useless in a way because they're too big to go in early at formation where you guys play. And they're too small to go in at the later growth stage where you truly have to deploy hundreds of millions of dollars to buy compute and do the capital intensive things that cash flow alone does not allow you to support.
I think people always should really understand the game you're playing and understand the game that those you're working with are playing. And to some VCs like Andreessen, I give them a lot of credit. They understand the game they're playing. They're building a media machine. They're playing to win that game where it's like, look, we can easily write $100 million check or more into X.AI at a $20 billion valuation. And not many others can. And even for them, if that's a beta play, not an alpha play, because let's say it's like a 1 to 10x or something like that, like that's still worth quite a bit, right? At the end of the day, at that check size and that type of money. And for their LPs who are looking at like, are you beating the S&P? Like that's a win. And they're playing that well. I think to your point, the middle is where people are going to suffer, where it's like, well, I've raised fund after fund and I've told the story about how I follow on for all these deals I do at seed. And I need those A's to continue along their happy path to B and C. What happens when those conversion rates drop off a cliff? And there aren't a ton of exits to be had for your companies. Do you have enough? And does the math work to actually return given the size of your fund? That's going to be tough. We all know there is a bit of Ponzi-ness in late stage VC where it's like, oh, well, somebody does my round here and somebody does my round here with no rationality where it's an actual exit. That was great if you're playing the fundraising game. But I think LPs are hopefully smart enough at this point where they're like, that doesn't always mean shit in terms of the actual return. Yeah. And at the end of the day, if people aren't seeing that because there aren't as many IPOs and the markups aren't actually translating to dollar on dollar value, what's going to happen? I only LP in small early funds. We're all biased, right? I think my biases are probably more to early. At least if there's a one round and done situation for a lot of great founders, I can still win because my fund's small and my 1, 2, 3%. Even at $100 million exit could actually be a pretty big return. So at least that part of it, I sleep a little bit better at night being an early. I could agree with you that a lot of people see the same thing. So that's why you're seeing pre-seed formation, round sizes go up so much. I think a lot of the mortality at pre-seed risk has gone down as well because you can turn through PMF iterations so much faster.
So much quicker.
Whereas 10 years when we started Clearbit,
but you also need way less capital. Like you used to raise capital because you needed to buy servers. And then we switched from once those became commodities, we just switched to buying engineers. Right. Now that one engineer, a really good engineer, can do the work of a team of 20, where you just don't need any more of that money. You can iterate so much faster to a place of revenue. And also like there is so many low hanging fruits. It kind of reminds me a little bit of the first shift to mobile where there were like the planets of the apps where like it was so easy like for an app developer to just turn cash flow because there was just like it's a greenfield kind of blue ocean type of there's so many things that you could automate for people that are not very well versed in the way that technology and LLM works to actually build it themselves. One of the common wisdoms about being an emerging manager and running a small fund, like being resource constrained, is that you got to wear 1,000 different hats, very similar to the way that a founder does. We covered a lot of good ground today, but what is one thing that we didn't talk about that you were dying to share that I didn't ask you?
I hope that for other LPs in your audience, they look to you to think about this because, I think I said this earlier, know the game you're playing, and that applies to being an LP too. Like if you're optimizing for, hey, we want to get checks into interesting companies at later rounds, like you may have that may be very smart for you then to write checks into early small funds because they're going to have inside data. They're going to you're going to have a better chance. Obviously, I'm biased, but I think early funds, and I only LP into early funds, small funds, also have better chance returns. But more than that, it's like, are you playing a game for access? And that should influence how you deploy into funds and probably how you underwrite your expectations of returns around those. If you're a pension fund, it makes sense that you'd want to back Sequoia or Andreessen because it's like buying IBM. It's safe. You're not going to get fired, number one. Number two, in those firms' cases, you'll probably have great actual returns. Certainly you'll have good on paper returns because they're in the best deals. Even forget entry valuations, the beta return value will be there. Later stage rounds will be higher in the pref stack. So your chances of losing money are quite a bit lower based on the exit. But it's a beta play and it's going to work pretty well. But that's the game you're playing, right?
And it's also really hard to deploy $250 million in a bunch of $10 million managers.
Right.
So if you are that size and that scale, you need those big platforms to exist. And also, if you're cutting a $250 million check per vintage, you do not expect it to 10x. Like, that's not what you're asking. It's like, first, don't lose it. And second, just give me beta on the public markets because I already have exposure to the public. That's where the bulk of my allocation is.
But all that said, I think there are very good arguments to be made. And again, I'm directly speaking against my own self-interest here, but I think there's a lot of flaws in the VC asset class. Like there's better alts out there. You would have made more buying Bitcoin and it's liquid and you'd do better in some ways doing other things. I think that the sort of like romanticism of like get super low, get in private, then it goes big. Again, I think that it's probably been overstated. And now there's so many alternative asset classes that like you can do well. If it purely is a cash on cash game, like I told LPs when we were fundraising our second fund, they're like, well, you know, how do you think you compare to like putting in the S&P? And I'm like, well, we don't. You should put it in the S&P, not Earl Grey. Like that's not the comparison that you should be making.
That's why you're doing this.
Right. But I also said, look, we're going to work like hell to make you money. We don't pay ourselves salary. We only make money from this if we return. We're going to work really hard to drive return. But if you're like, I want to invest $1 here to turn it into $5, there may be better ways, more liquid ways, shorter term ways, equally high risk, but you have to kind of care about the other things, whether it's tangible value in terms of getting to later stage stuff that maybe we surface, or intangible value of learning about technology, the network, or whatever else, right? I think you're being very intellectually dishonest to your VC and you're acting like, you know, you're the only game in town to make money. Yeah, it's not. It's actually one of the lesser ways in the scheme of things, but for a certain fit, it's tremendous, right? And that is on both tangible and intangible levels compared to other asset classes. It probably used to be one of the only ways to access private, where it's definitely not today. I've met so many smart LPs, family office types who, they're playing this very smart games with like, we do secondary funds. Like we buy stakes in GP funds that are like desperate for liquidity. It's like you're skipping the worst part of the J curve and shortening liquidity. And I've seen people do that with individual positions companies. Like there's so many creative ways now to do it. I think, again, like you really have to know your game or what you're actually playing for, whether it's just returns, whether it's something else, whether it's, you know, what you're actually in the job for. I won't publicly say who, but I've even heard of some LPs who are fundamentally misaligned with their constituents, where they're like, they're chasing logos and like short-term IRR because that gets them promotions. They're like managing a pension fund and that's getting them a promotion. They go do their next thing. They don't actually care whether that results in anything or not for like the University of blank taxpayer, you know? And it's like, even when you learn these are the incentives that drive behavior, it all makes more sense as to why stuff happens the way it does. But it's not always like some big rosy, everyone's going to 10X your fund in X years. And I think people feel pain and they're going to correct accordingly. It's again, going back to the very first thing we talked about, on one hand, it's great that the product's getting better. On the other hand, I think overall, if less funds are being funded, that is a very rational reaction from the market based on what's happened in the last 5 years. It's naive to think otherwise.
Yeah, I totally agree. This was great. I had high expectations and you delivered. This was a great chat. Thank you for sharing your wisdom. We'll see you around the early scene. You guys have been around the block a bunch and it doesn't seem like you're going anywhere.
You've just listened to another episode of Slice, the podcast for emerging managers. Thank you so much to Amit for joining us and having such a candid conversation. And thank you so much to Walter for introducing us to Amit.